Do you know what an income statement is? Do you know what a balance sheet is? Do you know what they tell us? This video is for you. In this video, we will discuss the income statement and the balance sheet. These financial statements represent two key financial documents that every business owner and manager should understand, even if only at a basic fundamental level. There is a general perception that accountancy is boring. While that may be a debate for another day, one thing is for sure: business owners and managers need to be able to understand and interpret financial statements effectively. Accountants and bookkeepers are not just a necessary evil required to meet regulatory and taxation requirements. Effective management of the business means effective management of the finances. Luckily, the basics are straightforward and easy to understand. Whether you are in the arts, the sciences, outright commerce, or making impact, you need these basics. With that, let's dive into the presentation. The starting point in bookkeeping is to consider three basic concepts of business that any business owner and manager already knows but must understand. 1. Your business needs to make a profit in order to be sustainable. 2. The business needs to be able to meet its financial obligations over time in order to avoid insolvency. 3. The business needs to ensure it is liquid or has sufficient cash available at all times to meet its short-term financial obligations. When we consider profitability, we have to question whether our income exceeds our expenses for a given period and leaves us with a profit. The opposite situation could also exist, where our expenses exceed our income for a given period, resulting in a loss. It is therefore important to remember that a profitable business will lead to higher valuations over time. When we consider solvency, we need to think about whether our business's assets exceed its liabilities, leaving shareholders with equity in the business. If not, the business is insolvent. Solvency is the ability of a business to meet all of its financial obligations in the long term. When we consider our liquidity, we need to think about whether our business has sufficient cash to settle its short-term debts as they become due. Assets expected to be liquidated in the short term are known as current assets. Liabilities expected to be settled in the short term are known as current liabilities. Liquidity is essential to ensure ongoing operations. And so, we start our financial understanding journey with these three concepts in mind: profitability, solvency, and liquidity. Next, we consider the typical operating transactions in a business. On the income side, we have sales revenue from the sale of goods, service fees from the provision of services, investment income from risking capital, and royalty income from allowing the use of your intangible assets. On the expense side, we have variable costs, which include cost of sales and sales commissions, and fixed costs, such as rent expense, salaries and wages, utilities, telecommunications, and stationery. And with those concepts defined, we are able to prepare our business's income statement by listing out the income and the expenses. From our income statement, we are able to calculate our profitability using the profit equation, namely profit equals income minus expenses. Next, we consider our business's assets. These are divided into current and non-current assets. Current assets include cash, inventories, and receivables. Non-current assets include land and buildings, vehicles, equipment, furniture, computer software, and patents. Next, we consider our business's funding. How are the assets we've described funded or paid for? There are two ways they can be funded. One, equity, which represents the owner's money. In the case of sole traders or partnerships, this would come from personal savings. In the case of a separate legal entity like a corporation, money would be raised through a share issue. Two, liabilities, which represent borrowed money. In the case of sole traders and partnerships, this would come from personal loans, credit cards, or suppliers' credit. In the case of a separate legal entity, like a corporation, money would come from a corporate bond issue, corporate loans, corporate credit cards, or suppliers' credit. And with that, we can prepare our balance sheet. We list our assets, equity, and liabilities. And from this, we can deduce the accounting equation. Assets equals equity plus liabilities. Now that we have our balance sheet understood, we can shift our attention to solvency and the solvency ratio. The solvency ratio is calculated as assets divided by liabilities. We should target a minimum ratio of 2 to 1. Next, we turn our attention to a more detailed look at the components of our balance sheet, specifically the assets and liabilities. We identify the current assets and current liabilities. From here, we can calculate our net working capital as follows. Net working capital is equal to current assets minus current liabilities. Here we would aim to have a positive result. And with that, we can make reference to our balance sheet and calculate our liquidity ratio. The liquidity ratio is calculated as current assets divided by current liabilities. Here we should target a minimum ratio of 1 to 1. And now we have a clear understanding of what profitability, solvency, and liquidity is. These concepts illustrate the importance of our income statement and balance sheet. In this video, we were introduced to three key financial concepts, namely profitability, solvency, and liquidity. In understanding these concepts, we made reference to two financial statements, namely the income statement and the balance sheet. It is worth noting that the income statement is sometimes referred to as the statement of profit and loss or the statement of comprehensive income. Broadly speaking, these terms are interchangeable, although there are some technical differences. It is also worth noting that the balance sheet is sometimes referred to as the statement of financial position. We learned to calculate the following. 1. Profit is equal to income minus expenses. 2. Solvency is equal to assets divided by liabilities, and we target a ratio of 2 to 1. And 3. Liquidity is equal to current assets divided by current liabilities, and we target a ratio of 1 to 1. Now that we understand the fundamental concepts, we will explore more detailed financial concepts and their application in future videos. However, at a very minimum, the concepts discussed in this video should be understood by every business owner and manager. If you enjoyed this content, please like the video, subscribe to our channel, and click on the notification bell. It helps us grow the channel and bring more content to small and medium business owners and managers. Also, be sure to check the description below for any related product affiliate links. And finally, please comment on the video or click on our community tab to further interactions and updates.